Thank you so much, sir, for this special address and outlining the significance of today's conclave. Now I invite Mr. Khosla and Mr. Dutt to please present a mementos to our special addresser, Shri Rao. Please round of applause for Shri Pramod Rao. Thank you, Mr. Khosla. Thank you, Mr. Dutt. Thank you, Shri Rao. Thank you, sir. Moving ahead with our panel one discussion on the topic fractional ownership, a scalable investment model. Now I invite our moderator and panelist on the dais, please. Our moderator for this session, Mr. Neil Borate, Deputy Editor, LiveMint, and panelist, Mr. Shiv Parekh, Founder and CEO, hBits, Mr. Vivek, Mimani, Partner Investment Funds, Practice Group, Khaitan and Company, and Mr. Saurabh, Managing Director and Co-Head of Real Estate, Motilal, Oswal. Round of applause for our moderator and speakers, please. Over to you, Mr. Borate. Thank you.
All right. I'm going to first break the ice with a small quiz question. So a mutual fund has an SID. What does an SM REIT have? What do you think the corresponding, if anybody's rifled through the documents, the offer documents for SM REIT, they have a very fun annexure, grabs the attention. Okay, so you can do that later as homework. An SM REIT has a KISS, key information of the scheme. All right, so let's begin first with a look back. It is 2 years since the first draft regulations were introduced. I remember getting super excited when they came out, and I put on Twitter, and I got hundreds of people mailing me for the circular. And then the final regulations came out. And we have finally one live REIT, another one filed with SEBI, and I think 5 players who've got licenses. So Shiv, do you want to take us through, you've been in this journey throughout, the journey and the current state of play?
So yeah, I'll talk a little bit about the journey from the regulation perspective. So initially when we started our business, obviously the idea was to give investors access to these commercial real estate rent-generating properties, where earlier you would only had your large funds, like your Blackstones and Brookfields of the world, or you had ultra HNIs putting 50 crore, 60 crore, 100 crore in owning these extremely attractive assets where one could get 8 to 9% rental yield. And historically, they've shown about a total IRR of about 15% plus or minus. So that's where we started. We were operating. And I think, obviously, SEBI took note of the industry and they called us in towards the end of 2022. And they understood and tried to understand what was going on in the industry. And at the end of the meeting, they asked us, would you want regulation around this? And we said absolutely. And we put in what we think the regulation should look like. I'm sure they spoke to other market participants as well. And then in May 2023, they came up with a consultation paper on the SM REITs, and I think that's what you are referring to, and I was as excited as you were. And again, we put in our views then. As per my knowledge, I think there were 70 responses to that consultation paper. And then in November 2023, the SEBI board approved it, and March 2024, the regulation got notified. And I think what was extremely heartening was that prior to that regulation getting notified, and I think post that regulation getting notified, I think SEBI had multiple of these seminars with the industry. I think Bombay Chambers organized a few. There was ones in Bangalore, Delhi. So we really understood how the regulator was thinking as well. So I think that's been the journey from the regulation perspective.
So Vivek, did you, again, taking a look back, you must have been tracking the regulations throughout. Did they pan out as you thought?
So from a regulatory perspective, when you look at it, what SEBI doesn't like is anything being unregulated. So to that extent, when Mr. Rao is talking about pooled vehicles, so that is a concept where you have everybody in a collective scheme where there's equal participation. So with the evolution of REIT, the SM REIT was exciting for us because you already had a model framework which was there for the REIT, which had, I mean, if you look at it, initially the listings did take time, but when it took off in a big way. So the same excitement was there with the SM REIT framework. And from a regulatory perspective, it was a short success to that extent. We had the framework in place. It had to be just modified to cater to the small and medium sort of properties to that extent. And I think going forward, and we are seeing one more listing, so we can just see how sort of this regulations can be modified to get the larger public sort of have participation in these structures. So I mean, overall, yes, we do have a mutual fund similar structure in place, I would put it.
Yeah, rightly said. And I think one thing that even I didn't realize for a long time is this very important distinction between tokenization and pooling, and how pooling safeguards you versus the risk with tokenization.
Yeah, so tokenization will maybe as a second step, we can see how we can tokenize some of these, but yeah, it's an evolution which, I mean, we have a lot of unregulated schemes in the country, right? And you need to protect investors. So we'll see the next step, I think, post this.
All right. So Saurabh, you've also been, I'm sure, tracking this space. Why isn't the big money pouring in? Why isn't the big VC money pouring into this evolving space? Or do you think it'll start now?
See, I think, so there are two parts to this evolution. The typical REIT, I believe, is an elder brother to the SM REIT, right? So a lot of capital currently is chasing the larger REIT, the typical REIT, because institutional players need size and scale. So any institutional player would want to see, okay, I cut a check today. Can I cut a check after 6 months, which is probably 1.5 times larger? And probably in 3, 5, 6 years, 10 years, can I do 10x of what I'm doing right now from an AUM growth perspective? At the same time, not compromising the returns and the liquidity. I think SM REIT, where it is today in terms of conceptualization, in terms of asset size, in terms of the way the regulator wants to look at it, and very rightly so, I think my humble judgment is it will take some more time for larger institutional capital to come in, because there's enough and more to do in the regular REIT space, right? At the same time, I also feel there will be, and as we continuously raise capital for various platforms that we manage, I think there is a very strong competition from family offices and HNIs, because they also vie for the same assets which typically would flow into an SM REIT from a manager, right? So I think limited assets to begin with historically. When I say limited, I also mean clean, readable, with a lot of diligence already completed, etc., and with limited amount of upgrading of those assets. I think that pool is still limited. People who have had early more advantage are the ones you see applying for license as well. So there will always be that gap of demand and supply, both on the capital side as well as asset side for SM REITs. But people are generally very happy on the way India as a country, and I think SEBI as a regulator has moved with the pace of regular REITs. So people are very, very happy to look at various asset classes. It's just that I think it's a matter of time. Maybe we are slightly faster in SM REITs than the regular REITs in terms of time to market. But there's a lot of excitement for people waiting to sitting on the fence, waiting to jump on a single asset check.
All right. So Shiv, along similar lines, what is your current Christmas list? You may or may not get it, but hey, here's a chance to let the regulator know. What needs to change?
Yeah, I think before, obviously talking what needs a change, we should also, because you always ask from the regulator, and I do have a couple of points, but firstly, what the regulator has obviously done extremely well, and one was obviously what I mentioned in terms of listening to the industry, taking the feedback, and accordingly shaping the regulation. But I think two things that have, even happened post the regulation coming out. I think one which Mr. Rao mentioned, again, after listening to the industry, was merging the real estate and infra definition from a REIT or SM REIT perspective, which means we're not limited to just office assets. We can do warehouse, schools, hospitals. And I think they saw the logic for that and they did that. I think the second thing, what you mentioned, obviously you're starting quiz, the KIT and the KIS. Obviously the name is great and we don't thank them just for the name. I think what they recognized was generally a normal IPO process, whether it's a traditional REIT or a regular IPO. SEBI would generally take about several months for the final approval to come. I think what they recognized is here, all assets that we list are not owned by us. In fact, it's not even permitted. There are no related party transactions permitted. So they're third party assets where there's a strict timeline where we need to give the funds to the seller. Otherwise, they'll walk away from that contract. So they understood that, and I think that's why they've come up with this KIT, KIS, which means one time you file a document for the trust, and then whenever there's a material change to that, you'll file. Otherwise, asset specific, there's just a much simpler scheme document, which then we're hopeful that SEBI will also approve that quickly. So I think those are the two major points that I think have been very good even post the regulation.
So one kiss is enough?
No, multiple kisses, right? Because there are multiple assets. One KIT is enough. So I think we're very, very happy that those things have happened. I think a couple of things that we would like to request, obviously, which we've also mentioned before. One is that 5% sponsor capital, if that can at some point be relooked at. Or if not, I think there's a scale at which that goes down from 5% to 3% to 1%, if that time period can come down. Because again, this is very similar to the regular REITs. Obviously, regular REITs have 15% because they have leverage. But again, REITs are able to put that in because they are the sponsors, they are bringing the asset themselves. We are a professional asset-light manager. So that's one. Other is, going into the market, realizing what's there. We're hopeful at some point this 500 CR threshold can increase to a few thousand CR. And again, the rationale is that we would like to take full buildings, and buildings can go up to a few thousand CR. I know the regulator mentioned that the regular REITs start at 500 CR, but I'd like to add 2 points there. One is that if you practically look at it, the market cap of the smallest REIT is above 10,000 crore. So there's no real REIT coming up with an asset base of 500, 600,000 crore. And other is that's not the only difference between the SM REIT and the REIT. The other major difference, or the other two major differences, is that one is an SM REIT. As an investor, you can pick and choose which scheme or which asset you want to invest in. And that's what investors want. And they want to do that in a full building, not just a floor in a building. And second is that there's no related party transaction permitted. So, I think that's the other major difference between the two. So that's the request we would have. One is on the skin in the game. Other is the asset threshold.
Vivek, would you agree with that?
So I think for the SM REIT to succeed, some of these points are very valid, right? At the end of the day, like you mentioned, you have to get in professional property managers, fund managers in place. Now, the way I have seen is, in case of an AIF, you are raising blind pool capital. There, again, while the threshold, etc., is higher, but SEBI has gone ahead and said that there is a minimum participation which you have at each scheme level, right? So somewhere, I think we should have that distinction so that at least from a property player perspective, they are able to launch more schemes. Because if your capital is locked in each scheme, there will be a limitation which will be created to that extent. And also from a capitalization perspective, from the fund manager entity perspective, that's slightly higher. I mean, we've seen like a person who has a hotel property, right? He wants to put that in an SM REIT. It is in a tier 2 city, 200, 300 crores, perfectly REITable property. But the capitalized
Sorry,
capital which
to your
gets locked.
mind, the 5% skin in the game, does it have a parallel in other, like mutual funds have skin in the game, but I don't know if
mutual
it's...
fund has skin in the game, but if you compare it with an AIF structure where it is 2.5% or 5 CR, whichever is higher.
2.5.
So maybe we can, if you're looking at an asset size of 500 CR, I mean, you can look at that range. And I mean, this will only facilitate you to do more projects. You can get more schemes into the SM REIT. And also from an investor perspective, currently, yes, for a few years, we should maybe look at the 10 lakh limit. But if we see how SEBI has modified it and said that we have a specialized investment fund in case of mutual fund, and that sort of deals with more complex products where you have derivatives and stuff. So real estate is something I believe at least most people understand. So the threshold also from an investor perspective could be reduced so that you have more participation. Today, if you look at the SM REIT which is there, it's like one unit getting traded a day. Maybe if some churn is there and trading is there, it will help people also understand what this product is, and exit is an opportunity which is there. Like you can buy today and sell tomorrow.
All right, Saurabh, is that what is holding back capital, the 5% skin in the game?
Yeah, see different platforms and different challenges, or requirements. I think sponsor commitment is always welcome. AIFs, in fact, it is low. If you were to ask us, AIF requirement should be far higher because it's a completely a black box product in a way, AIFs. But of course, REITs are templatized, fairly governed, simple products. I think two things that hopefully will help change the scale, if not today, maybe a year later. One, we are in a scenario where interest rates are very, very benign, right? A 1% drop in interest rate effectively means about 12-15% of NAV change, right? So the 500 crore number that we would have as an industry come up along with the regulator maybe 2 years, 3 years back, at least we need to adjust it for that number. Like we say, inflation adjusted real interest rates, something like that. So that needs to go up, one. Second, at the same time, luckily, last 3-4 years have been very tailwinded for entire real estate asset class, including infrastructure and sister industries. I think that has further shot the rates up significantly, right? Now, the moment you club these two, it has a snowball impact. That's where I'm not in a position to say what's the right number, but directionally, if that 500 crore number could touch somewhere between 750 to 1,000 crores, a lot of good assets will become eligible not only from a REIT perspective, but also for someone like us to enter, hoping that over 2-3 years we'll be able to REIT it out.
So basically you agree with Shiv that the upper limit of REITs should go up from 500 crores.
Also, my judgment is what it will help us with is liquidity. At the end of the day, liquidity will be important once a couple of these REITs see the light of the day, right? The moment you have that one small asset, limited inventory, no major know-how of the brand, etc., the challenge that Vivek said will come up. You will never have liquidity. And if there's no liquidity and trading, the entire purpose of having an SM REIT in the first place gets defeated.
Would you agree with that, Vivek, that it's what is keeping out the big institutions? So, I'll just complete the question. I as a mutual fund investor or as a retail investor would like to come in through an institution. I may not be able to figure out individual REITs, but if my mutual fund only does not want to participate, then I also cannot. So is it too small for mutual funds?
See, it's both. I mean, in India, you like to have personal real estate exposure, right? I will not get into the market side, but I mean, from an institutional perspective, the major REIT or the main REIT itself will take up so much capital that, I mean, if you look at it, 500 crore size, there will be limited participation to that extent. So I think it's more from a retail investor perspective. Yes, there will be your mutual funds, etc., which will participate, but then there is only limited participation which they can have given the size of the SM REIT.
So you do agree it is the size?
It will, yeah, size will have its constraint, but also we should look at more retail participation there.
Are there any other things stopping institutional capital, Saurabh or Shiv? Do you want to?
I'm not sure if it is stopping institutional capital, but coincidentally, in the morning, Shiv and I were also talking on this in some other forum. I think, and Mr. Rao, very humbly, we are putting this forward. जो campaign industry ने मिलके mutual funds के लिए किया है, which is to get retail participation, domestic retail capital coming to stock markets, let's say mutual funds. And that's where, given where we are globally, so many challenges coming up, Indian stock market has done reasonably well. Probably one of the better ones in the Asian subcontinent. I think that has happened because painstakingly over the last 7-8 years, regulator and other stakeholders have been educating people about the benefits of long-term investing, trying to avoid trading, going with institutional fund houses, as Neil is saying. I think that practice, we will have to do something around that for the REITs and the SM REITs. So if mutual funds say here, then we'll have to come up with something fancy to say REITs better hai, something like that. So people know what this is about. Otherwise, today when we are meeting even larger HNIs and family offices, unless they are very professionally driven, where decisions are being taken by professionals, a lot of people don't even know that a REIT and eventually SM REIT could offer a very compelling liquid fund counter asset class. If I had that money and I had to put money in a liquid fund or arbitrage fund versus a REIT unit, you have the liquidity in place. You have the best of the names today. The beauty of starting early is the first few names will be the best names, most well-governed names in the industry. So you have the best sponsor, you have the best asset in the country, you have liquidity on tap, you have those asset classes giving you between 6.5% cash yield, very, very attractively taxed, because now they are at par with any other equity market instrument. Plus you have an appreciation game of another 50%. So logically speaking, my judgment would be, if someone were to invest in a REIT today, should expect to earn between 10 and 12% very comfortably, over a 2-3 year period.
Sorry, how much? Can you repeat that? How much should people
I'm saying if someone wants to stay put over a 2-3 year period in let's say REIT units, possibly investor to REIT to REIT, an investor should expect to make between 10 and 12%, as an entry yield plus the cap rate, plus the capital appreciation. Now, people are not even aware of such kind of benefits. And if you look at post-tax basis, it's a very different game altogether. So, people are not even aware. Educated investors are not aware of the benefits of such things. So, I think a lot needs to be done on the communication part around these regulations and these asset classes.
No, so I completely agree, right? Let's break it up into two segments. The retail investor and the institutional investor. So I think from institutional investors, it's pretty clear, right? If the threshold is 500 CR per asset, and no one can put more than 25%. So for one investor, the maximum capacity put in is 125 CR. For an institutional investor, that's too small a investment for them to spend their bandwidth. They're investing in the thousands of crores, or at least several hundreds of crores. So I think obviously increasing the threshold there will help. And also I think when the industry gets to a level where you're launching multiple assets simultaneously, then they can look at allocation across multiple assets. And I think we're not far away from that, by the way. I think the reason the industry is where it's at today is that that's normal in the first 1 or 2 years of people getting their feet. But as people do, I think in the next 2-3 years, there will be a dramatic growth. Coming to the retail investor perspective, I'll just, I think there is a dramatic lack of investor education, where we will take some level of responsibility that we will also get investors educated. But let me just throw some numbers. 50% of Indians' wealth is invested in real estate, and that's not counting your primary residence. 20 to 25% is then invested in fixed income instruments. So 70 to 75% of people's wallet is actually in secure, safe rent-generating, yield-generating products. So the question is, how do we take that wallet and move that over here? On the flip side, if we look at REITs, the market cap of the 4 listed REITs is about 90,000 crore, of which the retail investor participation is about 10 to 15,000 crore, which is minuscule when you compare it to, say, mutual fund of 50 lakh crore. And the reason is 100% not because of the product. The product has done extremely well. You look at the performance of REITs in the last, since inception, it's been in the 10 to 14% range. High level, that's higher than what large cap mutual funds have given you. So from a risk-adjusted return perspective, REITs are offering a better return. The question is more to educate the investor of the product. And I think it's a matter of time, conversation. And once that is done, I think the appetite for investing will dramatically increase.
Yeah, I would add one more reason to that mix, what deters me personally from REITs, and that is tax. So the existing SM REIT that's got launched, I think had a 9% yield. Now, if I tell you, I'll give you 9%, some of you might be interested, but many of you will still go to sleep. It's an okay number, it's not a bad number, but in a raging bull market, people start expecting 12, 14, 15%. But the moment I say 9% tax-free is the moment you will sit up and listen. So Shiv, I want you to give folks a very quick tax overview of the kind of distributions that REITs do, and what you told me the other day, that how you can possibly deliver 9% tax-free is what will interest them.
So I think obviously the traditional REITs have a combination of repayment of capital, interest, as well as dividend, and therefore they all have slightly different tax structures. I think for SM REITs, and this is obviously in conversation with our tax advisors, is that if it can be structured as your rental income that's coming into the company can be paid out as repayment of capital, then in your hands today as an investor, there's no tax. Your cost basis does reduce. So say you bought the property at 1,000 and I've paid back to you 100 as rental in that first year as repayment of capital, then your cost basis will become 900. But on that, you'll pay tax when you exit your share. Say 5 years down the line, you exit it for 1,500. Then you'll pay your tax on that delta at that long-term capital gains, and now it's on par with equity as well. So in that sense, it becomes highly, highly tax efficient. Although, Neil, I want to say that even pre-tax, people will not sleep at 9% because they need to think about the upside as well in the property values rising. And property values rise because of a couple of different reasons. Primarily 3 to 4 reasons. One is obviously you're under-rented, so you can get a higher rent. Second is your rents generally escalate 5% every year or 15% every 3 years, kind of tracking inflation. Third is generally infrastructure development around a property causes appreciation on that property. And fourth is a falling interest rate. A falling interest rate will kind of across bonds and fixed income products will cause the property value, or in this case, the unit value, to rise.
Yeah, so some smart structuring could actually deliver a large part of the REIT return tax-free. But I would still submit that if a mutual fund does it, I get it tax-free anyway, whether the REIT pays dividends or rent or return of capital or what have you. You want to come in?
Yeah, but Neil, there is a classic fallacy in that thought, and I'll tell you why. Investors increasingly are moving towards asset allocation. So they are not comparable asset classes. A REIT giving you 9%, whatever, give and take, let's say 9%, versus a large cap giving you, let's say 15%, are not comparable asset classes because the returns of 9, 10, whatever, and we're completely discounting the capital appreciation for a moment. I think it is not volatile. If the REIT is stabilized, then every quarter you will get what is kind of guided. Maybe 90% of that, because anyways, a trust has to distribute 90% of what it earns and 100% in this case. So your returns are they're not guaranteed, but they're very, very certain, unlike a mutual fund or a large cap mutual fund in that sense. So an investor should look at all kinds of asset classes, a mutual fund giving them a very long-term wealth creation alternative, a small cap, mid cap giving them a delta where for the amount of capital they don't have to use at all. But everyone will definitely, depending on their risk appetite, would want to lock in between 10 to 30% maybe, depending on the age also, towards fixed income or fixed income plus kind of products. That is where a structure right REIT, and that to tax efficient structure, works very beautifully.
Do you want to comment, Vivek, on that?
No, I clearly agree with Saurabh here. The whole purpose is to have more products available to the investors. So I think in India, REIT was a great innovation which when it came in, I mean, it just offers you more opportunities to invest. Like investing in real estate is always challenging, right? You have to do the title diligence and get all the legal formalities in place. But here it is as simple as logging into your online account and you sort of invest and you get those returns to that extent. And the distribution is fairly regular. So you can get a space in, say, one of the business centers in Lower Parel for like today at 10 lakhs, right? It's one investment. So mutual fund, even if you look at it, there is a lot of categories within it. So this is like a whole new asset class.
Yeah. So I was arguing it more from a tax point of view that if my fund invests in REITs, I'm happy because then I don't have to care about the distribution, the nature of the distribution. When I redeem my fund, I'll pay my long-term capital gains tax. So that's my limited argument. Okay, I'm going to open up very early for questions. And before that, I'm going to throw you guys a question. So how many people have invested REITs in the audience? Please raise your hands. Wow, that's one hand. It's one hand. Invested education. Okay, so people who haven't done so, do you want to tell us why not? What's holding you back, right? Ultimately, we can, discuss and theorize, but I'm very keen to know what are your concerns about REITs? Can we pass around the mic? Yeah, one sec, they'll just get the mic to you and you can talk.
Yeah, lack of information. No idea is it.
Yeah, current slowdown in the real estate markets, that's stopping us.
Okay, let's pause here. Do you guys want to address the slowdown?
I wouldn't think there's a slowdown. I don't know if you disagree, Saurabh. I think it's the, at least in commercial real estate, I think there's very, very little supply. Relative assets. So equity markets have performed extremely well in the last several years.
See, I think, especially when it comes to REITs, I appreciate your concern if you are picking up a property for yourself. Let's say you are buying a commercial space just for renting out and having an annuity income. But when you're looking at REIT, these typically, and I believe most of these REITs that we already have available on the markets, would have the best assets of the country in the best micro markets of the cities, which are probably the hotbeds of infrastructure and employment, right? Unless we feel that Indian economy is not going to grow by 5-7% that we typically target, I doubt that, and it's just only a judgment, I doubt that the rental yield will fall down any further, right? If you look at increasingly, all these asset classes under REIT are, most of them, and Shiv can correct me, are between 88 to 95% leased out.
SM is 100.
No, but already which are there, the larger,
Yeah,
100%, 88, I'm saying practically no vacancy. Whatever is getting vacant is actually getting leased out on a mark-to-market rental. So there is also a rental escalation which is inherently available, for the time that whatever, if things don't go right. And lastly, sir, by the way, I don't manage any REITs. So on the platform, I am the least conflicted guy. But I genuinely feel I'm very appreciative of the asset class. Thirdly is, India in the last 3 years has built or supplied or absorbed significantly more commercial real estate than ever it has done in the past, right? And of course, a lot of it has to do with GCCs. Every year, increasingly next 7 years, we are expected to have 100 GCCs, which is Global Capability Center, coming into India every year. This number was less than 65, 15 years back. So that is the kind of demand that's coming to the country. The vacancies still remain very, very moderate, sub 15%. There can be pressure on rentals, I agree with you, but I don't see vacancies going up disproportionately because of the slowdown in the market. Yeah.
Okay, let's hear some more answers. People are raise their hands. Yes,
Yeah.
please.
So there's an. You want me to stand? Okay, fine. Yeah. So there's an issue with respect to buying. You in mutual funds, for example, you were comparing with mutual fund. For mutual fund, you don't need a demat account. For you REITs, you require a demat account. So probably that is one hindrance, I would say.
Yeah, so I was actually this close to buying a REIT, and incidentally what happened was I was in a Brookfield property, and because I was part of a Brookfield property, on the screens you could see they were trying to sell the Brookfield REIT. This is probably 2021 or 22. And there was a very simple, 50,000 rupee investment kind of they were trying to do some sort of an advert. So that's probably the only time I've seen a REIT in front of me. So I think shelf space, jo dikhta hai, wo bikta hai. I don't know if I can, maybe it's a distribution issue. I don't see it on my investment app. I just checked right now. Under equities, there is something called REIT. So I don't think that's the same product. So I suppose this is probably, it's not available to me where I am present. It was at one point. I considered it then, but there was no easy way for me to sort of go and actually execute it.
Okay, Shiv.
No, I mean, this is in a sense what I was referring to, right? It's the awareness, it's what you see is what you buy, and it's not in front of you, so it's not in your mind share anymore. So you've forgotten about it. So you don't, and I think that's the case with most investors. They are not aware of the product, they're not taught about the product. And I think, I'm not sure of the InvITs numbers, but at least in the REITs, I'm saying again, the retail investor participation has been low. Institutions have come in because that's who the sponsors who've listed the REITs have ultimately pitched to. They've pitched to a Bain Cap buying a large share in one of the REITs. So the retail investor education hasn't happened to the level that would allow people to be aware. And I think that is where SM REITs do come in. Because the traditional REITs have focused more on institutional. We do want to focus more on retail, because that helps obviously the everyday investor get access, and that builds more liquidity because then the number of investors will become much higher. So I think, we'll personally obviously take responsibility to push that, and I think it's a question of the whole industry taking responsibility on pushing that awareness and education on this asset class.
Okay, any more?
Just to add here, I think the slight also confusion is that it is looked as an equity product, whereas it's a yield product more in the lines of your debt funds or your FDs to that extent. So it's giving you that 10 to 12 or 9% versus equity return. So I think that's also big.
Any more reasons as to why you guys haven't bought? Is tax the reason? Are you guys clear on how this is taxed? The 4 kinds of distributions: rent, dividends, return of capital, and interest.
What's the best way to get it, for example,
What's
if I
the
want
best?
to? Where do I sort of go to?
So for an SM REIT, obviously it's kind of like applying for an IPO. Given that this will be kind of through your broker, you could apply for a SM REIT when it's listing a new asset. For REITs that already exist, that you can trade on your Zerodha, I'm sure it would be available, or any of your platforms. On the tax front though, Neil, I would like to mention though that in the prospectus, players do mention that, what is the post-tax yield, depending on if you're an individual, if you're an HUF, so it's very clear what you would be getting on a post-tax basis. I guess the prospectus is a several 100-page document, and it's providing that to the investor in a more consumable way as well, while they can read the prospectus if they want to.
The very long kiss.
Yes.
I think, one thing that I have noticed, Shiv, and this is again, sorry I'm asking on your behalf, one question. And a lot of friends also ask this. The challenge is you're buying a stock. This is what it is and this is the market cap. and then you have hundreds of ratios very easily available on all the apps, price to book, PE, PEG, etc., etc., etc. And people somehow have become very comfortable talking that parlance, jargon. On REITs, the most important parameter at a point in time is your entry cash yield, right? Now that is something people have found it very difficult to know while investing, right? So I think that is, if you could tell people where could they see that, so that it's a far more informed decision, because it's not that I can buy REIT today and then tomorrow and day after tomorrow. It's also important at what point I'm entering. Am I entering before the rate cut, after the rate cut? So am I investing in an expensive REIT, or it's a value opportunities? How should people look at that?
No, I think what you said is absolutely right, right? In equity investing, there are multiple ratios that people track, and there's a whole industry that's built around it probably for the last 40 odd years in the country. And I think for REITs, it's just starting. So obviously it's a question of, we will publish what we think, and obviously what's permitted on our website. But then it's a question of, journalists or, say for example on a money control, because right now when I look at a stock, you'll go on money control and see the different ratios. So it's creating that common language across the various players. I think there's also an index on REITs as well. So I think a lot of this common language needs to be created. It's a matter of time, industry to evolve, but it's the various stakeholders, because we can only speak so much. It's when third parties speak about the industry, it obviously carries more credibility. But yeah, I think that's extremely important knowledge for investors to have as well.
Hi.
Could I just quickly intervene with few points? Sorry. So one, indeed, I hear the point about investor education, awareness, and so on. So both REITs and InvITs have formed themselves into associations, practically like Amphi exists and has done the mutual fund Sahi Hai. We have given REITs a tagline of saying REITs right hai. So I don't know whether that will be catchy enough and take it forward. But equally for those who are interested in investing, it is exactly after an IPO listed on the stock market. So whether you use your broking apps, whether you go to tell your broker what you want to buy, I think all REITs, InvITs that are listed, publicly listed, are available. All REITs certainly so. IPO is the other time to buy. The third, I wanted to just share that about 6 months ago, we launched what are called data benchmarking institutions aimed exactly at REITs and for InvITs as well. There is a CAMS, K-Fintech, and a CareEdge offering, which looks at these three. So you could just Google them and see. They track all of them so that you can actually compare between different REITs, different InvITs. So there is that common language, so as to speak, getting built. It's the equivalent of how, there might be tracking for just mutual funds, Value Research does that, and so on. So like that, we have these three data benchmarking institutions which are focused on REITs and InvITs. I thought I'll just add to just for all of the benefit. Thank you.
Hi, I have a question. I run a financial consultancy firm, and I have quite a few of the family offices who have a very plain vanilla idea, who tell me, why don't we go to a private equity fund, and we know when are we going to exit. Maybe it will be after 6 years, 7 years. Everything is quite written, and of course then the return that a PE fund has written on their brochure or their expectation is pretty high. When it comes to a REIT, we are not aware, running a financial consultancy firm, I'll tell you, I am not aware on how to explain what would your exit strategy be. When can you go ahead, and maybe how many years you need to be invested. So how does it pan out? And of course, being the typical Indian mentality, everyone needs a certain percentage attached that after 5 years, 6 years, 10 years, like this is the minimum base returns you can get. So how do we decide that, and how can we take it ahead?
So I think from a, choosing between a AIF and a SM REIT, I think firstly they're both great options. I think obviously Saurabh is running one of the best AIFs in the country on debt investing in resi under construction. So that's resi, that's under construction, that's debt. It has its own risk reward ratio. Here in REITs, you'd be investing in constructed, rented out, rent-generating assets. There are AIFs that are doing constructed, rent-generating assets as well. But there, ultimately, it's a close-ended fund generally, where you're giving your money to a manager. The manager is investing it across X different assets which you might not even know prior to investing. Ultimately, you're taking the call on that investment manager. So that's obviously one way of investing. What REITs offers is, because it's public REITs and SM REITs, the disclosures that we'll have in our draft offer document, you'll know the exact price that you're getting in today as well, of which asset, who's the tenant, all that you might not know in an AIF model. In terms of exit strategy, I'd say there are two different paths that one could exit in. One is obviously in a 5-6 year period, again exiting the asset, selling the scheme, or rather selling the SPV to an investor and returning the capital to the investor. But the other way obviously is, given that it's listed, an investor can exit his or her share on the platform at any point in time, or rather on the exchange at any point in time that they want. The units are in your demat account. You can trade that and sell that to anyone. There are yearly, we have to publish a yearly valuation report from a third-party valuer, so you have some guidance on the asset value as well. So those are kind of the two exit avenues that there would be.
All right, hand.
Hi. I just have one question out of curiosity that, today we see around 45 registered asset management companies in India. And since we have been comparing REITs with mutual funds here, and we are also talking about low awareness of REITs, I also think that, one is the demand side issue, but also on the supply side, why is it that, there are only, we only see 4 REITs which are actually publicly listed, right? So why is it that, we don't have so many issuers of REITs at this point of time? And possibly that might be one of the reasons why, even the awareness on the demand side is less?
I think maybe partly you are right that it's still early. I'll not say because the supply is low, because even if all of us want to invest today in any of the REITs, we have the liquidity available to invest. But yes, we also need to give credit to the fact that, all these are fairly new asset classes. We will take some time. If I were to compare it globally, very broadly put, in Australia, US, UK, 93 to 97% of listed real estate is sitting in REIT. In India, it is 10%. One can say that they're 50 years advanced in terms of starting a REIT, etc., because REIT started in 1965. I think first REIT started in 1965. Global average is 60%, So, and we are at 10. So, very easily between REITs, SM REITs put together, there is at least a headway of about 5 to 6 times of what we are seeing today, growing to that number. Even today, of the retail stock and various database managers have different numbers, but very broadly, we have about 850 million square feet of grade A assets, of which retail supposedly is about 500 odd million square feet, of which only 120 million is retailed so far. So that's sitting 380 million square feet, which is 3 times of what we see today, already retail, supposed to be rated over a period of time. Everyone is also aligning their books, getting into the compliances so that they don't fall on the wrong side of the law. So definitely, even if a company wants to do an IPO, from the thought that I need to take my company public to the day I see the IPO of that company, if at all, that's a 3 to 4 year process. Because it's a combination of multiple factors, including setting my documents right, my records right, etc., right up to the IPO. So for a regulation which has been existent for 50 years, and still people will take between 2 to 3 years to list out, depending on the complications, I think it's only fair to say that in 3-4 years, we have the kind of market that is already there. Next 3-4 years, I see this number growing to at least 7-8 REITs compared to the 3 on the office side that we have.
And also one slightly nuanced point is that in the REIT, you're saying there are 4 listed REITs today, while mutual fund, I forget the number, but 50 managers maybe?
45.
55 managers. So the managers of the mutual funds are all professionals. They are not the issuer of the stocks in that sense. While the REITs currently listed, they were the developer themselves. And as of today, there are no professionally managed REITs. Could be for various factors. So I think SM REIT obviously offers the opportunity for professional managers, and that regulation is just over a year old. So I think now we're hoping that it'll come up in this industry as well.
All right. One last question.
My question is...
sorry, go ahead.
So my question is about SM REITs in particular. I mean, if I look at regular REITs, they have full-fledged corporate parks, etc., as a part of the asset base. But when you look at SM REITs, I believe 2-3 floors of a particular building also can be put into a REIT and just put in a REIT. So I mean, doesn't that increase the risk for an investor? Say, for example, a particular building has 10 floors. 8 of those floors are not well managed, not well maintained. 2 of those floors probably in the start are well maintained, but then in the future there's no incentive for that, the REIT manager to continue to maintain them because it's off their books. So I mean, what do you think about that?
No, I think that's a great question. And I think what one should look at is who are the tenants in that building. Ultimately, it's the tenant that cares, the occupier that cares about the maintenance of the building. So not just the tenants that are on those 2 floors that a REIT is listed, but all the other floors, who are the tenants. That obviously gives a certain proxy that are those tenants satisfied, how long have they been there, and obviously a lot of this information will be provided in the prospectus of the REIT that's launching. That'll give some proxy that, okay, even though there are multiple co-owners in this building, is the building being well maintained or not? And in commercial real estate, there is this, a thing that a corporate park, because there's one owner, would be better managed. To a degree that is true, but then if you look at, 95% of residential societies in the country are managed, and a lot of them managed well by multiple society holders. So I think there are a lot of other parameters that come into play as well.
So it's
out of
not
time,
the
yeah. One last
it's not the question. It's just to add on the answers. They are not 4 REITs. There are InvITs also in our country. So the cap is bigger. And second, like the gentleman asked, like where he can see. So in equity, we can not see the REIT and InvITs, but there is a separate segment known as the hybrid securities. So whenever like anybody is going and seeing, they need to just select hybrid in their system, and they can see all the like listed InvITs and REITs. Just to add on your answer. Thank you.
In their broking account, right?
Yeah, in their
Okay. All right.
hybrid securities. Hybrid securities.
All right. I thank my panel for taking out the time and sharing the valuable insights. Thank you also for being
Round
such
of
an engaged
applause.
audience.
Thank you experts for making this session so interactive and engaging. Once again, a big round of applause for our panelist and moderator. Now I invite Mr. Khosla to please come on dais and please present the mementos as a token of our appreciation to our speakers, please. One group picture, please. Thank you. Now would like to take a short 10 minutes tea break. Please enjoy your tea and coffee. We'll be back in 10 minutes.